Zara is running late. It is a Wednesday evening. She has just picked up her daughter from an after-school program, and they are moving through a supermarket together faster than Zara would like. Her daughter wants cereal, the good kind, the kind with the cartoon on the front. Zara picks it up, reads the price, puts it back, picks up the cheaper one. Her daughter doesn't argue. She has learned not to. At the checkout, the total is higher than Zara expected. It usually is. She taps her card. There's a pause. The card reader thinks. It approves. Zara exhales. Not loudly, just enough. On the bus home, her daughter falls asleep against her shoulder. Zara looks out at the city, the illuminated shop fronts, the banks, the phone screens glowing in other people's hands. She thinks about the card, not about the purchase, about the number behind it, the balance she has been carrying for 14 months, the minimum payment that comes out automatically every month, the interest charge that appears on the statement she almost never opens all the way. She knows what she owes roughly. She does not know exactly what it is costing her. That is the gap the industry depends on. What just happened to Zara at that checkout is happening to roughly half the adult population of the planet's largest economy right now. In the United States, Americans collectively owe $1.28 trillion. That is $1,280 billion in credit card debt. That figure, recorded at the end of 2025 by the Federal Reserve Bank of New York, is the highest ever measured in more than 25 years of tracking. It has risen 66% in just 5 years. 111 million Americans, half of every credit card holder in the country, cannot pay their full balance at the end of the month. They carry it forward. The industry has a name for these people. They call them revolvers. Not because it is a weapon, but because the debt just keeps turning. And it is not just America. In the United Kingdom, more than 10 million adults, 1 in 5, use products called Buy Now, Pay Later schemes, services like Klarna and ClearPay that let you buy something today and spread the cost across weeks or months. The United Kingdom's Financial Conduct Authority, the country's financial watchdog, found that people who use these services are more than 4 times as likely to have missed a payment on another bill. The sector grew 200 times in size between 2017 and 2024. It operated almost entirely without regulation until 2025. In Brazil, the average interest rate on a revolving credit card balance reached 450% per year. Not a misprint, 450. A debt of $1,000 left unpaid for a year would become $5,500. Brazil eventually capped credit card rates at 100%, meaning a debt can only double, and even that is considered a significant consumer protection. This is a global system. The mechanisms differ by country. The result is the same. Ordinary people are borrowing money to cover ordinary expenses, groceries, medication, school supplies, bus fares, and paying back far more than they borrowed. The difference between what they borrowed and what they pay is called interest, and the story of how that interest got this high is not a story about market forces. It is a story about a decision, a specific decision made in a specific room in a specific year, and it changed the financial lives of hundreds of millions of people who were never in the room and never got a vote. We need to go back to 1978, not to a bank, to a courtroom. For most of American history, there was a law protecting people from being charged extreme interest rates on borrowed money. It was called a usury law. The word usury comes from the Latin for the use of money, and a usury law simply set a ceiling on how much a lender could charge to let you use theirs. Think of it like a speed limit. You can drive, but not faster than a certain speed, because beyond that speed, people get hurt. Usury laws said you can lend, but not at a rate higher than this, because beyond that rate, people get destroyed. In 1978, most American states had usury laws capping credit card interest at around 12%. Some capped it lower. Then a case called Marquette National Bank of Minneapolis versus First of Omaha Service Corporation went to the United States Supreme Court. The Supreme Court is the highest court in the country. its decisions become the law of the land. Here's the case in plain English. A bank based in Nebraska was sending credit cards to people in Minnesota. Nebraska's interest rate ceiling was higher than Minnesota's. The Minnesota bank sued the Nebraska bank for charging Minnesotans more than Minnesota's law allowed. The Supreme Court ruled unanimously that the Nebraska bank could charge whatever rate Nebraska allowed, regardless of where the customer lived. The legal principle established that day is called interest rate exportation. It means a bank only has to follow the interest rate rules of the state where the bank itself is based, not the state where you live, not the state where you spend the money, the state where the bank decided to put its headquarters. At the time, almost nobody noticed. No headlines, no protests. But 2 years later, a banker named Walter Wriston noticed. Wriston was the chief executive, the top leader of Citibank, one of the largest banks in America. Citibank was based in New York. New York had a usury law capping credit card interest at 12%. In 1980, inflation was running so hot that Citibank was paying 15% to borrow money itself and only allowed to charge 12% to lend it. The bank was losing money on every credit card account it held. Wriston needed a state with no interest rate cap, or one willing to get rid of theirs. In February 1980, Citibank's lawyers went to South Dakota. South Dakota had no usury limit. The state was also struggling badly. Family farms were failing, the economy was weak, and the state desperately needed jobs and investment. The deal was simple. South Dakota would formally invite Citibank to open a subsidiary there, a smaller branch of the bank. Citibank would move its entire credit card operation to South Dakota and bring thousands of jobs with it. South Dakota's legislature passed what people called the Citibank bill in just 22 days. Not a single person testified against it in committee. The governor signed it on Valentine's Day, 1980. Citibank moved to Sioux Falls, South Dakota, and immediately raised its interest rates on credit cards for customers all across the country. Other banks watched. Then they did the same thing. Delaware abolished its usury limits. Nevada followed. The biggest credit card companies in America quietly relocated their headquarters to states with the weakest consumer protections and charged those rates to customers everywhere. The decision attracted little notice at the time, but critics and defenders of the credit card industry have agreed that it opened the door for vast changes in how the industry does business. The speed limit was gone, and the industry floored it. This is how the machine runs today. Mechanism 1. The minimum payment trap. When you receive a credit card statement, it shows you two numbers, the total you owe and the minimum payment, which is the smallest amount you are required to pay that month to keep the account in good standing. The minimum payment feels helpful. It is not. In the 1970s, minimum payments were set to 5% of the balance. That meant you were always meaningfully reducing what you owed. Then, quietly, over decades, credit card companies lowered the minimum. Today, most minimums are set to around 1 to 2% of the balance, just enough to cover most of the interest charges, with a tiny sliver left over for the actual debt. Here is what that means in practice. Imagine you borrow $5,000 on a credit card charging 20% annual interest. You pay the minimum every month, faithfully, never miss a payment. It will take you more than 15 years to pay off that debt, and by the time you are done, you will have paid nearly $5,000 in interest alone, almost as much as you originally borrowed. You will have paid for that $5,000 debt twice. Credit card companies reduced minimum payments in part because lower minimum payments created more profitable accounts. The longer you stay in debt, the more interest accumulates. The more interest accumulates, the more the company earns. The minimum payment is not a kindness, it is a design feature. Mechanism 2, the profit margin that kept growing. When the Federal Reserve, America's central bank, raises or lowers its interest rates, you might expect credit card rates to follow. They do not symmetrically. When the Federal Reserve raises rates, credit card companies raise their rates quickly. When the Federal Reserve cuts rates, credit card companies barely move. The Consumer Financial Protection Agency, the United States government agency created to protect ordinary people in financial markets, published an analysis in 2024 that found the average credit card interest rate had nearly doubled in 10 years, from 12.9% in 2013 to 22.8% by 2023. The agency found excess profit margin alone may have cost the average cardholder over $250 in 2023, and that major credit card companies estimated $25 billion in additional interest revenue simply by raising their margins. The banks didn't get riskier customers, default rates did not rise significantly, they simply charged more, because they could, because there was nothing stopping them. Mechanism 3. The credit score as a gatekeeper. To get a credit card and to determine what interest rate you pay, you need a credit score. In most of the world's major economies, this means a 3-digit number calculated by a private company using your borrowing history. In the United States, the dominant system is called the Fair Isaac Corporation Score, known universally as the FICO score. It ranges from 300 to 850. The higher your score, the cheaper your credit. The lower your score, the more you pay. Here is the problem. The Fair Isaac Corporation score is calculated using your history of borrowing, repaying, and using credit products. If you have never had a credit card, a mortgage, or a formal loan, if you have always paid in cash, you may have no credit score at all. You are credit invisible. An additional 21 million Americans have no credit history with any national reporting agencies. And to build a credit score, you need to borrow. But to borrow affordably, you need a credit score. This is the circle, and it has a door that only opens from the inside. Credit scores range from 300 to 850, with 54% of black consumers reporting a poor or fair score of 620 or less, compared to 37% of white Americans. This is not because black borrowers are less responsible. It is because the data used to calculate the score reflect a history of exclusion, redlining, predatory lending, barriers to homeownership that we examined in detail in Episode 5. The score does not measure character, it measures access, and access was never equally distributed. The 5 largest credit card banks in the United States, J.P. Morgan Chase, Citigroup, Bank of America, Capital One, and Discover, control more than 2/3 of the entire credit card market. Interest income from credit cards totaled around $174 billion across the entire banking industry in 2024. The numbers behind that figure are worth sitting with. Over 5 years, Visa made $67.5 billion in profits. MasterCard made $44.3 billion. American Express made $33.8 billion. Banks borrow money from the Federal Reserve at around 4%. They charge customers 20 to 29% on their credit cards. Banks had a profit spread of 8.2% in 2007. By the end of 2025, they had expanded it to 17.1%. When the Federal Reserve cut its rates in 2025, the banks kept their rates high and simply pocketed the difference. This is not capitalism finding its equilibrium. This is a protected industry extracting maximum value from customers who have no alternative, because the alternatives were systematically eliminated in 1978 when the speed limit was removed. The Consumer Financial Protection Bureau, the agency created specifically to stop this, was established in 2010 as part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was the United States Congress's response to the 2008 financial crisis. The idea came from a Harvard Law School professor named Elizabeth Warren, who argued that financial products needed a safety watchdog the same way physical products did. The agency returned more than $21 billion to consumers who had been defrauded by financial institutions in its first decade of operation. In February 2025, the agency's director was fired. Its staff were ordered to stop all work. Its Washington headquarters were closed. Its website displayed an error message. The Elon Musk-led Department of Government Efficiency targeted it directly.
Several of Musk's own companies had been under active investigation by the agency at the time. The watchdog was muzzled at the exact moment the debt crisis it was designed to address reached its highest level in recorded history. Her daughter is in bed. Zara sits down at the kitchen table, the same table from last week, the same overhead light, and opens the credit card statement on her phone. All the way this time. She finds the section she usually scrolls past. It shows her the minimum payment, and then, in smaller print below it, a calculation she has never looked at directly. If she pays only the minimum each month, it will take her 22 years to pay off the balance. The total interest she will pay over that time is listed in full. The number is almost 3 times what she currently owes. She reads it again. She has been making this payment for 14 months. She thought she was staying on top of it. She thought the minimum payment was a floor, the least she had to do, but that she was at least keeping it from getting worse. She was not. The balance is higher now than when she started. Not because she has been reckless, because she occasionally needed to put something on the card, a prescription, a school trip, a coat her daughter outgrew, and the interest that accumulated each month was greater than the minimum payment she was making. She is on a treadmill. She is walking. The treadmill is faster than her feet. She puts her phone face down on the table.
She knows she is not the only one. She has always known that. Half the people on her bus, in her building, in her daughter's school, they are all walking on the same treadmill, at different speeds, toward the same nowhere. What she is only beginning to understand is that the treadmill was not an accident. Someone built it this way. Someone set the speed. The treadmill Zara is on was engineered, not evolved. The minimum payment was deliberately lowered over decades to extend debt and maximize interest revenue. The credit score system locks people out of affordable credit by measuring a history of exclusion and calling it individual risk. The interest rate ceiling that protected ordinary borrowers was struck down in a single Supreme Court ruling in 1978, and the resulting race to the bottom between American states has been running ever since. And none of this is unique to America. In the United Kingdom, the buy now, pay later sector, services that let you split a purchase into smaller payments, grew from £60 million to £13 billion in 7 years. It did so almost entirely without regulation. The United Kingdom's Financial Conduct Authority, the country's financial regulator, found that 1 in 10 buy now, pay later users had missed a payment on a bill or essential expense as a direct result of the scheme. In 2025, the British government finally brought the sector under formal regulation. The language used by the Treasury Minister announcing the change is revealing. She said the sector had been operating as a, quote, Wild West. In Australia, consumer credit card debt rose despite central bank rate cuts in 2025, with the dollar value of delinquent accounts climbing sharply. Younger Australians, particularly those under 30, are falling behind on payments at rates that echo the trend seen in the United States. In Canada, average non-mortgage consumer debt per person reached $22,000 in 2025, driven substantially by credit cards. Young Canadians, those under 25, are experiencing the steepest rise in missed payments of any age group. In Brazil, credit card interest rates had reached 450% before the government intervened with legislation in 2024. Even after the cap, the maximum rate allowed, 100%, means a debt can double in a year. Campaigners noted that the cap was still higher than the rates that would be considered predatory in Europe. The pattern is identical everywhere. The people who need credit the most, because they have the least, pay the most for it. The people who need it least pay almost nothing. This connects directly to what we explored in Episode 5 about the inheritance gap and what we called the bandwidth tax in Episode 2. If you have wealth, you borrow cheaply. You pay off your balance monthly. The card is a convenience. It earns you points and never charges you interest. If you have no wealth, you borrow expensively. The balance carries forward. The interest compounds. The card is not a convenience. It is the last line of defense before nothing. And it costs you more with each month that passes. So what actually changes this? There are named, specific, active interventions with evidence behind them. The most significant current legislative effort in the United States is a bill called the 10% Credit Card Interest Rate Cap Act. It was introduced in February 2025 as Senate Bill 381, a bipartisan piece of legislation, meaning it has support from both major political parties, led by Senator Bernie Sanders, an independent from Vermont, and Senator Josh Hawley, a Republican from Missouri. A companion bill in the House of Representatives is led by Representative Alexiana Ocasio-Cortez, a Democrat from New York, and Representative Ana Paulina Luna, a Republican from Florida. The bill would cap credit card interest rates at 10% for 5 years. At today's average rate of 28% on a $5,000 balance paid at the minimum, a consumer pays $11,000 in interest over 24 years. Capping rates at 10% would save that consumer over $7,200. Banks would still earn over $3,700 in interest from the same consumer. They just could not charge as much. The proposal is estimated to save working families $100 billion every year, providing average interest savings of $899 per person annually. A coalition of more than 55 organizations, including the National Association for the Advancement of Colored People, the American Federation of Teachers, and the Consumer Federation of America, signed a letter urging Congress to advance the bill in February 2026. The banking industry opposes it. The American Bankers Association called it government price controls and warned it would restrict credit access. This argument has been made every time anyone has proposed limiting what lenders can charge. It was made when the Military Lending Act capped rates for active duty service members at 36%. That cap did not destroy credit access for soldiers. It protected them from predatory lenders who had specifically targeted military families. The credit union alternative matters here. Credit unions are not-for-profit financial cooperatives owned by their members, not by shareholders. They are legally required to cap their credit card interest rates at 18%. Federal credit unions have served low-income communities for decades, often in neighborhoods that commercial banks have abandoned. Low-income designated credit unions have originated $13.5 billion in small business loans and provided $67 billion in financial benefits to consumers. Self-Help Federal Credit Union operates more than 80 branches across multiple states with a specific mission to serve communities excluded from mainstream banking. These are not theoretical models. They exist. They are running. They are proof that lending to people the mainstream system rejects does not require them charging them rates that compound them into perpetual debt. Beyond the interest rate cap and credit unions, community development financial institutions, organizations certified by the United States Treasury Department to provide affordable financial services to economically disadvantaged communities, represent a third architecture. They exist in the space between predatory commercial lenders and the formal banking system, providing credit-building products, small dollar loans, and financial education to people the Fair Isaac Corporation score has locked out. The European Union caps consumer credit rates across member states. Australia's National Consumer Credit Protection Act sets regulatory floors for responsible lending. The interventions exist globally. The question is whether the political will to implement them matches the scale of the crisis. This is what I want you to keep in mind. Zara is not in debt because she is bad with money. She is in debt because she needed things she could not afford to buy outright, the way most people in most countries need things they cannot afford to buy outright, and the system that exists to help with that was designed to extract the maximum possible amount from the people who can afford it least. The interest rate that compounds on her balance every single day was made possible by a Supreme Court ruling in 1978 that barely made the news. The minimum payment that keeps her on the treadmill was deliberately engineered to be too small to make real progress. The credit score that determines what she pays to borrow was built on a foundation of exclusions she had no part in creating. The people who built this system will tell you it is simply the price of risk, that people with less wealth are more likely to default, so they must pay more to borrow.
that this is mathematics, not malice. But the speed limit was removed by a decision, not mathematics. The minimum payment was lowered by a decision. The credit score encodes the consequences of redlining and segregation, which were also decisions. Every mechanism in this machine was built by human hands in service of specific interests. In Brazil, those hands were eventually forced to move. They capped the rates. Not low enough, but they capped them. In the United Kingdom, a decade of Wild West lending is finally coming under regulation. In the United States, a bipartisan bill exists right now to cap credit card interest at 10%. It has sat in committee while banks lobby against it, and families pay $368 million a day in interest. The machine is not inevitable. It is a choice that keeps being made. Zara knows this now. She looked at the number on her screen. She read it all the way to the end. The number is not her fault, but knowing that does not make it smaller. What makes it smaller is dismantling the machine that produced it. Now you know how it was built. Help someone know by subscribing to the channel and sharing the video. See you in the next one.